and you'll have an amazing life. You buy a duplex every year for 10 years, you are in the top 1%.
Always work in the business and not like on the business. And I think to be a successful business owner, you need to look at it from like a higher level.
I'm sacrificing the empire for a pot of gold over here.
Welcome back to Sky's the Limit podcast. We're your hosts, Mike and Ryan. And today's episode is a little special. We're honored to have our first guest, Axel Ragnarsson, who's the founder and CEO of Aligned Real Estate Partners, a real estate investment company with roughly 45 million in assets, 450 units across the country. And we're very fortunate enough to have him on here. So we'll bring him in. We'll talk about a lot of things. We'll unpack how to find off-market deals, how to fund them, how he just got started, and now he's built this behemoth of, I mean, it's massive. You go to his website, it's really impressive. So really, really excited. I think it should be a great episode for all levels of real estate investors, beginning, medium, large. I think we can unpack a lot of stuff. So Axel, great to have you.
Yeah, I'm glad to be here. Appreciate the invite, guys.
Absolutely.
You are our first guest. I hope you feel so honored.
I feel incredibly honored. I'm gonna bring it and be worthy of the first spot for sure.
I'd love to learn just maybe a quick update to everyone who's listening, who you are, what you do, and how you got started.
Yeah, for sure. So I live in Boston, to give everybody a geographical sense of where I'm at. So grew up in New Hampshire, southern New Hampshire, went to college in New Hampshire, now live in Boston, been down here for the last 6-7 years. My dad was an immigrant, so he came over here from Sweden. He started a wood chipping business, and him and my mom ran that for a long time. So I was always exposed to kind of entrepreneurship at a young age. Nothing to do with real estate really at all, or finance or anything, but just around business ownership growing up. And I think that, and maybe I had a little bit of a kind of entrepreneur DNA or bone in my body that really pushed me at an early age to try and find other ways to make money that wasn't necessarily working a job. So high school and college was doing a lot of different things to make a buck, flipping cars, electronics, starting little side hustles. And eventually I got to a point in college where I was trying to think about, all right, what am I going to do when I graduate? And like when I actually leave here, what am I going to do? Because I'm pretty unemployable. I had a couple of jobs at that point that I quit 2 or 3 days in, both of them. I just couldn't make it past the first week with jobs I got. And I was like, all right, well, if I'm going to work for myself, I got to figure out what that is before I get too close to graduation here. So, I don't know. It might have been HGTV, it might have been an Instagram ad. I can't remember what it was, but got teed up some, education on house flipping somewhere and started to learn about real estate and thought that was a pretty cool way to make money. You go out there, you buy a house, you fix it up, sell it, make the spread. Seems like a pretty simple path to making some serious money in the short term. And started going down that road and learning about real estate with that strategy in mind. And this is my junior year of college or so. I'm in my early 20s. And as I was learning about flipping houses, I started learning about rental real estate, multifamily real estate, passive income, buy and hold investing. And that is what really spoke to me at the time. And I figured, if I can hustle and figure out a way to build a portfolio of these small multifamily properties that pay my rent, that's a pretty good spot to be in. So late college, I just became hyper obsessed with buying a property and spent a lot of time educating myself, looking for deals, trying to find people to lend me the money, and started buying small 2 to 4 unit properties tail into college. And then when I graduated, I just jumped into doing that full time. I got my real estate license as well and brokered some deals, but it was all in pursuit of building a portfolio of multifamily real estate. So to speed up the rest of the story, did that for a few years, built a portfolio of 50, 60 units that I own myself. This takes us up to 2019, 2020. And then around that time, I realized I wanted to scale. I wanted to get a little bit more serious about what we were doing, start buying larger deals, start raising capital from investors because I was starting to get stretched pretty thin with my own dough and my own resources. So throughout 2020, 2021, started making offers on larger deals, which at the time were 20 to 80 unit apartment complexes. Started looking for investors that could help me fund those and did a few deals throughout that time period. We started doing deals outside of New Hampshire, which was where I'd predominantly done deals up to that point. So started doing some stuff down in Florida. Started, while continuing to build the portfolio in New Hampshire. Along the way, we started a property management company in New Hampshire. And to wrap it up, we basically blew the business up with investor capital, bought a few hundred units in the last few years, started the management company, like I mentioned, raised a bunch of money, and looking to continue doing that and continue doing larger deals, doing more deals, bringing more investors into our ecosystem and growing the business.
So you've never, besides the jobs that you've really had for like maybe a week or so, you've never really held a real job.
Yeah, I worked at a grocery store when I was in high school, and that was like really the only job that I had. It's funny, a couple of years out of college, I'd maybe done 4 or 5 deals, but like I was starting to run into walls from a lending standpoint because I didn't have a W-2 income. And I took a job down in Boston. That's why I originally moved to Boston from New Hampshire, was moved down there to take a sales job at a tech company. And my 3rd day in, I missed a call from a seller that received a direct mail piece I was sending out. And by the time I got home and called him at like 7:30 at night, the guy went under contract with somebody else, and I would have made the same amount of money on that deal as I would have in years working at the job. And I was like, this just doesn't make any sense, right? Like, makes no sense that I'm sacrificing the empire for a pot of gold over here. So I just dove in full time at that point. So no, I've never really had a corporate gig. It's I worked as a broker, like I said, for a couple of years, but that was mainly just a side hustle to stay in the real estate game while I was looking for my own stuff. The first deal I did was a 3-unit in my hometown. I emailed the seller who had listed one of the units for rent, saying, I don't want to rent, but I'd like to buy it, make an offer. Yep. Knew it was a mom and pop type of landlord. And, it was like a $275,000 property, put it in a contract at $200,000. And I was working an internship at the time in college with a guy who did some private money lending. Like, he was my manager at this internship I had. So and I had been trying to build a relationship with him over the course of my time working there. And I took the deal to him and said, this is a $275,000 property. I got under a contract for $200,000. It doesn't need that much work. And he was like, yeah, I'll just loan you the $200,000. Because of all kinds of equity. I was buying it below market, right? And he made his money 12%, couple of points. And that was how I got started, really.
Yeah. So he charged you basically what any like hard money lender would charge you is, 2 points. So 2 points on the $200,000 would be $4,000. Yeah. 12% on $200,000 over the course. And it's interest only, I assume.
Good return for them.
And so what was your exit strategy? Because were you planning on refinancing it, selling it? Like, how were you planning to pay that gentleman back?
Yeah, so my goal was to get the unit leased up, because I took over with a vacant unit, and the other units were really far below market on rent. So I wanted to push them over the course of a few months and then go out there and refinance it with a local bank, local community bank, some kind of local lender. What I realized when I went to refinance was that's where I started to run into the wall from not being too financeable at that time. So the options available to me were, some kind of commercial loan, 20, 25 year amortization period, bit of a higher rate, 70, 75% loan to value on the refi. And this property had some weird attributes to it. It was like an older building with a weird septic tank, a dug well. It wasn't something that I saw myself owning long term. So I ended up just selling it, made a couple bucks selling it. And then on the next deal, because this will be a good answer to your question. Same thing, same lender, same situation. This time it was a cold email. It was a 3-unit property in Manchester, New Hampshire, where, public utilities, and this is something that I was more enthusiastic about owning long term and actually refinancing. And when I got to the point of refining that out of the hard money I had, it was infinitely easier than I would have anticipated, because I wasn't trying to go and get like a Fannie Mae or a Freddie Mac 30-year fixed rate, 80% LTV residential loan. I still can't qualify for that now. It's absolutely absurd how hard it is to qualify for just a regular Fannie Mae, Freddie Mac loan if you don't have a W-2 salary. So I went to commercial banks, commercial lenders, and they're more interested in underwriting the deal versus the borrower. They obviously care about the borrower. They want to make sure you haven't been foreclosed on, you have decent credit. And I had started to use a credit card. I had started to build my credit score in the interim. And they were like, hey, yeah, this deal makes plenty of sense. Debt service coverage ratio is great. Location's solid. It's fully stabilized. I had the rents all the way up to market. And granted, the terms weren't as competitive as what I would negotiate on something similar now. So I, maxed out at a 70 LTV on it. They gave me a 20-year AM. Now I would push for a 30. So the terms weren't great, but it got me out of the original loan and into a commercial loan. And that became the playbook for the next, 20 deals I did was refi with local banks, local community lenders.
Isn't that crazy how, especially now, it's so much easier for you to get a student loan to go to college or to go to grad school and go
Unbelievable.
hundreds of thousands of dollars in debt. Way easier to do that. You'll get a proof like that versus getting a mortgage when you're actually making money. I can show you I'm making money. Maybe I'm not your perfect W-2 employee and I have, 5 years of history, but say you're a 1099 worker, you're self-employed and like you need to provide 2 years of tax returns. And if you're not there yet, it is definitely more of a challenge, but yeah, I could go get a student loan right now for $100,000, $200,000. And that people get that at the beginning of their college career with
they
no
don't have
job
jobs.
history. They're like,
Correct.
how do you know what I'm going to do when I graduate? You
Exactly.
know, it boggles my mind.
It boggles my mind as well.
Jesus.
You were talking about some exit strategies, right? That one property with the weird well and the septic you didn't keep, but you found another one, a triplex in your town that you did keep, and it was on public utilities and all that. What's your thought on this? Are you of the mindset where you're like, keep everything? I want to keep everything, accumulate as many units as possible, or are you of the mindset where, look, I want to scale, so I need to sell off some stuff that maybe isn't performing so that I, get some cash to buy something bigger? Like which party are you in?
It's more meaningful to have big chunks of capital than it is a few $100 a month in cash flow. And that statement is a little bit dependent on your personal goals. If you're somebody who makes a lot of money at their W-2 or in a different business, maybe you don't need to flip or sell or be transactional with what you buy on the investment side because you already have money coming in from different places. For somebody like me who was coming into this, I was making like 50, 60K a year as a broker. It wasn't really like making a lot of money. Every once in a while, you just got to sell a property to bring money back into the business so that you can then reinvest it in different areas, whether it's in another deal or whether it's in some marketing or whether it's in a piece of software or whether it's in a virtual assistant to help you underwrite and to help you, email owners or what have you, right? And, this was something that there was one specific deal that I remember where I really started to think about this because my original goal is I want to hold everything and I don't want to give up the cash flow. I don't want to give up the cash flow. If I'm selling units, then my portfolio is getting smaller and it feels like I'm taking a step backwards. When in reality, oftentimes you're taking one step backwards to take 3 steps forward.
Right.
And I remember buying this duplex in Manchester. This was maybe my, 5th deal or so. And it was in a beautiful area. It was, kind of an A-class area. It was a more recently built property. It was built in the 80s. Got it at a great price, had all kinds of equity. And when I was looking at the cash flow that I was generating, free cash flow in terms of what it was leased at, versus what I would earn if I sold it and actually cashed in on the equity after transaction costs, my return on equity was like 5, 6, 7%. It wasn't anything that was compelling really. And yeah, maybe, I'm paying down the principal a little bit and I'm earning, all in 10, 11, 12%, some figure in that range. But I was like, I'm in this game to make 40, 50, 100% on my money, right? And when you're early, you really need to be thinking about how you can stretch your capital so that you can get more deals under your belt a little bit faster, so you can grow more quickly. And that was where I was like, all right, it's nice to make $400 or $500 a month from this. It's paying half my rent. This is great. I don't want to give that up. But receiving one large lump sum is way more impactful in my life right now. And I can go and put that into a few more different deals, right? Go find 3 more deals that are discounted. This could be my, the equity I need to actually close on these. Now I've, accessed a number of, or a larger number of units, and I can keep turning that money over. And I'll end with this. When you think about where you add value I'll just speak as a multifamily investor, what you're being compensated for doing, which is finding a great deal, implementing that early business plan where you're doing some renovations, you might be improving the management quality at the property, pushing rents, reducing expenses, doing all of the stuff that you plan to do to create the value. All of that stuff happens from the day you close to usually month 12, right? Maybe if it's a bigger deal, it's month 24, 2 years in, something like that. After that point, your returns are just dependent on the macro real estate market. You can do a little bit better if you're a great operator. Maybe the market rents are going up and property values are increasing. And, maybe you're even that much better of an operator than the market average. So you make a little bit more over the long term. But really, all of what you're being compensated for doing as an investor happens from the day that you close, which is when you set your purchase price, which is the most important number in the entire process. And then you do your renovations, you do your management improvements. And then after that, you're kind of done. Like you've already made all your money. So oftentimes it makes sense to cash in on the value you've created and go do it again. And instead of it being a nice little, linear line up the graph, it's more sporadic and it jumps up and jumps up and jumps up. And that's how you actually scale a real estate business. And again, that's assuming that your goal is you want to rapidly build a portfolio. If you're someone that wants to buy a duplex every year and retire in 20 years, then don't listen to this because it's probably not the advice for you and you just have a different set of goals. But for somebody like me who is, I want to build a business around this, you kind of have to be thinking like that.
100%. Ryan and I talk about this all the time. We're going through it as we speak on a building. We can get into that. But I think we kind of just came to this realization that it's going to take so many properties to live off the cash flow. Like things always come up inevitably in any type of real estate, whether it's your single family house, it's a multifamily, office, retail, industrial, like doesn't matter. Things are going to come up and that can eat away your entire year's cash flow just like that. And so the deal that we're like, should we sell it? Should we not? It's like, oh, we just bought the thing and we want to be long-term buy and hold investors. And it kind of goes against your core principles and your core values. But it's like, I could be looking at a $500,000 payday. How long is it going to take me to make a $500,000 in cash flow? Like maybe never. If you so like this particular building, Garden Street, right?
Yep.
So we bought this property 2 years ago for $1 million in Farmington, Connecticut. It's an absolute beautiful building. We actually got it on seller finance terms. We put 15% down. We did a 1031 exchange into it to purchase it. So if we did sell it, we would have to pay capital gains unless we 1031 again, and we'll get into that. But we put $150,000 down. So our principal balance is $850,000. Very simple. And the original owner did a seller finance, so we paid them 5.5% interest only. We have an opportunity. In my opinion, the building's worth $1.5 million. So we bought it for $1 million. We could get 1.5. We just got an offer for 1.35. That's it's $400,000. If our principal payoff is $850 now, like that's $450,000. How long? Like the building makes cash flow if nothing goes wrong, $30,000 a year. I mean, like.
Mm-hmm. That's assuming everything goes right.
Yeah. It's
and that's the big point, Ryan. Yeah. That's still a projection. Like at the end of the day, it's not guaranteed that it's going to produce that. That's a projection at the end of the day too. Yeah.
Oh, it's so conflicting because you're like, well, yeah, but like what else? Then you have to buy something else with it because you're not just going to sell it and go buy a car or go, it's like you got to reinvest it. So it's, man, I don't know. I still like go back and forth. I guess if you have something better to turn that, the reason to sell that property in 1031 into something bigger and better, and maybe that produces more cash flow, you can justify it. We go back and forth all the time on this, all the time.
Yeah. And I think, I think when you work backwards in terms of what your goals are, then the answers start to be a little bit easier. Like if you're I want to grow, max growth, maximize what I can earn per dollar. I'm okay with taking some risks. I want to push. I want to spend a lot of time in the business. Then you make one decision, which is oftentimes recycle cash, versus I really like my day job. I want to spend time with my family, but maybe you're like risk avoidance in this situation. And you're like, all right, that's fine. I'll just keep paying down the principal and, on this building. And yeah, I could make more money today selling it, but that's fine. I don't even know what I'm going to do with the money. And I kind of like the idea of, my LTV now being really low on it because the value's gone up because it's worth more. So I think it's a different answer for everyone. But, and the other piece that you mentioned, Mike, too, is like, if you're going to constantly be selling and recycling, you need unbelievable deal flow because the last thing you want to do is just be selling and then buying deals that are mediocre because the transaction costs are going to eat into your margin when you start doing that. And then it's actually a net negative. So you have to be consistently finding deals at 15, 20, 25% below market so that you're still coming out ahead when you factor in transaction
But what's
costs.
really interesting, and I'll play devil's advocate because you actually said this when you were giving that explanation, was that maybe that money that you're accumulating from these sales, like maybe it doesn't go into a property because you mentioned maybe it goes into a VA. Mm-hmm. Maybe, with say a $400,000 sale, if we were to get that money, just for an example, how many full-time employees is that? Like how, that could be 4 really rock star employees. Like what is that? Like, and if they're generating at least their salary in say wholesale deals or something like that, like
right.
we don't even consider that.
Always work in the business and not like on the business. And I think to be a successful business owner, you need to look at it from like a higher level and how am I going to grow this? Because like if Ryan and I died tomorrow, like no one's going to be able to pick this up. Like we are the business. And I think to really scale efficiently, you need to have systems, you need to have processes, which we're always working on. But I feel like we spend a lot of time in our business and not working on the business. So but the other thing is like, you could do that, except there's no tax advantage to doing that. If we collect that $400,000 and reinvest it into the business, not in a real estate asset, we're going to get taxed. Not only going to get taxed on the purchase of that property because we 1031 into it, but also on the sale of it. So you really have to make sure, like, look at your numbers, talk to your accountant, and make sure it's worth it if you're going to go that avenue, which it may be worth it.
Yeah, 100%. I mean, what you just mentioned, Ryan, is something that I did a couple of years ago, which was we sold a bunch of small stuff like 2s and 3s and made a couple of, in the US, like salaried hires. And, it's like, we like to invest in real estate because of leverage, right? We can leverage the bank's money. We can leverage investors' money. But there's also the form of leverage through building a team, right? And it's maybe their salary is 60, 65 a year with some incentives. Yeah. But if they find a handful of deals, whether it's an acquisitions guy, I mean, we have a full-time acquisitions guy that's US based in our business. And he finds 3-4 deals that are sizable. He finds $1 million deal that we buy at $800,000. That is such a better use of that capital than any real estate investment. Investments in people, almost, if you do it the right way, that's the big caveat, almost always has a higher return from a percentage.
You're financing your time in that essence.
Time leverage. That's what that
it
is.
You're buying back your time. So you get to 50 units. Then what? Then what kind of like went off, or like what was the light bulb moment? You're like, okay, I want to start raising private capital, like on a larger scale, syndicating, joint ventures. And how did that form, and how does that look today?
Yeah, I think I realized, I was like, what got me here is not going to get me there. And I think different people when they're growing their business hit that at different points, right? I think that's kind of like, I would imagine a lot of folks listening to this that are, whether it's in your career or like, in a business you're growing, you realize that what you're doing is no longer producing the same results that it has been. So for me, I was like, well, this is great, but I'm growing in a pretty linear fashion. I can't grow the unit count. I can't really grow the business in a systematizable way, in a scalable way, just using my own money. And what I was, my objective, again, it all comes back to, I think, your goal is like, I had a very clearly defined goal. Like I wanted to build a real estate company. Like I didn't want to just personally invest in real estate and, take a couple of vacations a year. I was like, I just really enjoy it. So I was like, I want to build a team. I want to hire. I want to raise money. I want to buy bigger deals. I want to do more deals. Like that was my personal objective. And in order to do that, I just had to raise money to do it. And the reason that we financially needed to raise money was I didn't have enough liquid cash to go out there and buy, a 50 unit deal at $5 million and bring $1.5 million down. Like I was not able to do that myself. Right. And so that was one reason. The other challenge I was having at the time was it's really hard to build a sizable real estate portfolio with your own cash if you don't have money pouring in from other sources, like a really high paying job or a really profitable business, because I was somewhat reliant upon that time of cash flow from investments, successfully selling some properties, successful cash out refis to fuel the engine to keep buying more. And I didn't really have enough cash left over to make those hires, to keep sending the direct mail and the marketing on a consistent basis, to leverage any of my time. And I could feel myself getting spread a little thin, and I didn't have as much capital in hand for reserves as I would have liked. And I started to kind of feel like I was like, this is just really stressful. I don't really want to do this. I'd rather just buy a deal, raise the money from investors, and then we're done. We have all the capital we need for that project. I'm not pulling some money from this property and paying for renovations over here. And for me, I was really interested in making the business much more simplified in that respect. So those were the major two reasons. And then after that, it was just a matter of, okay, so now we got to go find investors. Hadn't done that before. I've raised a bunch of private money and worked with private money lenders, but that's an entirely different ballgame than raising equity capital, raising capital from partners that are going to be in for the life of the deal. And that became, what we started to solve for. And then it became a delicate dance of got to keep looking for deals and finding deals, but we also got to start building the investor network. And finding investors and building a base of accredited folks that want to invest in your deals is infinitely more challenging than finding good real estate deals, in my opinion. And that was a much, much harder thing to solve for. And that's still something we're still trying to figure out. it's the hardest part of the business. Raising money is a lot harder than finding great deals, is something that I've learned. And as I've spent more time in that realm, that's where now I spend most of my time. And that was really what I started to focus on at that point, which was a couple of years ago.
You didn't just own a deal or two and then you're like, hey, I want to go borrow someone's money, a
So
$500,000
passionate
or
about
$1
this.
million, whatever. It's like you had a 50 unit portfolio track record before you even started thinking about it. And so I think a lot of people get caught up with like, how do I raise private capital? Well, how many deals have you done? What's your resume look like?
I do commercial lending, like what you talked about, DSCR, hard money, all that kind of stuff. And I'm sure you've seen, you're on all the Facebook groups and everything, and people are always looking to raise money or get financing for deals. And I'll come across a lot of people. They're like, oh, I appreciate your terms. I'm really looking for a private lender. And like, I'm looking at their track record that they submitted. It's like, but why would someone give you their money? Like, you haven't proven yourself.
Yeah.
Like, that's the whole thing. It's like, people always ask us like, oh, who's your private lender? It's like, well, I'm not really going to give you that because
It's like the contractor, and you don't want to give out your best contractor.
I mean,
either.
they are lending us their money because they trust us.
Right.
Like there's that level of trust that you have to build, at least I think, with all of your private lenders and probably your investors as well. Like, you've got to be like, hey, look, this is what I've done. This is how I'm going to not lose your money.
Right.
And like, is this a deal or not?
Right. I'm going to ask you the question. What do you like more? Do you like more units under one roof, bigger numbers, bigger expenses, hopefully higher cash flow? It's not always true. You have different opportunities that come with that, tax benefits, cost segregation. You're not going to do a cost seg on a 2-family, probably not. But so what do you like? What's your sweet spot?
Yeah, I think of what we do in like Aligned Real Estate Partners is kind of like my day job. And then I still go out there and buy real estate myself, right? But, most of my time is spent looking for the large deals to pair with the investors we have. But if somebody calls me up and is like, hey, I know this guy is selling a, 6-unit, I'd love to take a look at it and just be something I personally buy. Because my North Star, my end game is still owning a nice sizable portfolio of real estate with, moderately leveraged, non-recourse debt that's free cash flow to me. Because I know my motivations are going to change over time, right? Now I'm trying to every dollar that I have, but when I'm 40 or 45, like, I'll probably be more risk averse and I won't want to take a lot of risk. And I'll like the idea of having a bunch of units that I own at 50% LTV or whatever. I think there's something to be said for like, you've been doing something for so long and specializing your knowledge for so long that like to move to something else, you're just starting from scratch and you're just giving up all the progress you made and what you've done. Even though I'm buying a 3-unit, like it'll probably be a flip. I don't think that 2 to 4 unit properties, it's great to get going with them. That's how I started, right? But like from a long-term cash flow standpoint, your return on equity is always just going to be so much lower than if you just jumped up a little bit and bought 5+, because such a large segment of the 2 to 4 unit buyer base are just owner occupants, right? So your price per unit is significantly higher for a 2, 3, or 4 unit building comparatively to the price per unit for the same unit sizes, same rents, same all of that for something that's 5+. So it's like your 3-unit that sells for $600K. I'm just making up numbers here, $200,000 a unit. If you had a 5-unit with all the same units, it might sell for $150 a unit, but you're still getting the same rents at the end of the day. So if I'm going to hold something longer term, it's got to be 5+ nowadays. And I basically look at 2 to 4s as like single family homes now. I want to be transactional with them. Yeah. If you're just a casual investor and you're getting started, by all means, hop into a 2, 3, 4 unit.
You happy with your corporate W-2 job or job in general, and you want to buy a couple of properties, you just had, some kids, and you're like, in 20 years, I'll sell these off and it'll pay for my kids' college. But I don't have any ambitions to be scaling.
Yeah. And you'll have an amazing life. You buy a duplex every year for 10 years, you are in the top 1%. So,
like I said, we go back and forth on this all the time, but commercial, so 5 units and above, if we're talking multifamily, it's a different animal. And the reason why it's compelling for a lot of people is because when you're getting appraisals, more importantly, it's mainly based on the income approach. And so when you're buying a commercial asset, let's say a 10, 12 unit building, it's directly the net operating income and the cap rate. So those are like your best friends. Like, find out the going cap rate in your area. And if you can increase the NOI by either increasing rents or decreasing expenses, you can, with a good amount of certainty, 80 to 85% certainty, figure out you can easily change the value of your building by just manipulating that net operating income. You cannot do that in a 2 to 4 unit property. There basically is no NOI in my because it's all, if you're going to go sell it or you need to refinance it, cash out, do all these things, it's sales comparison approach. It's what's the other neighbor, what's the other house, my neighboring house going for? That doesn't exist in the commercial world. So I think there's bigger upside
Absolutely.
that you can control. Like you can control what your neighbor does with his house. He could let that thing go, sell it, and that's a terrible comp for your property,
Exactly.
right? So,
Exactly. No,
and
100%. Yeah, you're in more control of your own destiny when you're buying 5.
and there's
plus
so
unit
many
stuff, for sure.
ways to increase your net operating income or decrease the expenses.
Absolutely. Yep.
So many ways. Coin op
Yeah.
washer dryers, increase parking. You start charging storage. I mean, we have garages in a lot of our properties. We rent them out, usually to outside guests, but like outside tenants, I should say. But they'll pay 100 to 150 bucks a month. My fiance owns a 4-unit in New Britain, and it has a 5-car garage. 150 a bay she gets.
That's amazing.
That's another unit.
Yeah.
That's literally another unit.
A good example is like the office building we're sitting in right now. The virtual offices.
Virtual offices.
We don't even need to give up any space, and people will pay $100 or more for a virtual office.
A mailing address and a business address for Google reviews and a place to send mail.
Yeah. That's all going to add to the NOI.
Yeah.
And value. Do you have time to dive deep into one particular deal that sort of stands out in your kind of a long track record of yours?
Yeah, absolutely.
Okay. All right. What do you have in mind? Is it a 2 to 4 commercial, sort of a pivotal property?
Time frame, this is mid 2018, I believe, is when we bought this one, when I bought this one. 6-unit, Manchester, New Hampshire. Found it through a cold email to the owner. Bought a list, skip traced it, got the emails for the owners. And an intern at at UNH who I was paying like $15 an hour, and he would just send emails to owners. And when someone would reply, I'd take it over and I would work through the sales process. And so we found this deal. It was 6 units. It had gone through a fire and basically a major renovation back in 2012. So it was like a newer building from the foundation up. And it was in an area of Manchester that was, so-so. It was probably, C+ area, not the best, not the worst. And the owner is the one who bought it after the fire. So he bought it for like 25 grand, spent tons of money rebuilding it, probably like 300 grand or something like that. And about 5 years later, he wanted to sell it for 485, which I know, a lot of folks listening is like, is that a good price? You maybe don't know the Manchester market. At this time, that was a really, really good price at 80,000 a unit or so. Big 3-bedroom units that he was leasing for $1,250 a month, which was far below market. And he, as the seller, was really interested in doing a seller financing deal. So it's not even something that I brought up. He wanted to hold paper because of some tax reasons and because he didn't want to, he kind of liked the idea of having some income still coming in. So we put together a deal. I paid him a little bit more than he was asking because 485, I ended up, we put under contract at 500. The difference didn't really make that big of a deal to me. And financed 95% of it at 3% interest, which he wanted 5, but I was like, I'll give you another 15 grand if you just, and we did like kind of the difference in interest payments over the time. I was like, you'll basically pick up another year of interest payments, and I don't plan on being on the loan for that long. So he was a fan of that, and we had a 3-year term on it. So we got in there, didn't even run it. I mean, the building was in great shape, so we didn't really have to renovate units. When leases came up, we gave plenty of notice to the tenants. We're like, hey, we're bringing your rents to $1,575 to $1,650, depending on what floor they were at. Nobody left. None of the units turned over. I refinanced out of the loan with the seller and pulled all my money out, and then someone appraised it, I don't know, like 750, 775 or something like that. And then a few years later, we sold it for $1 million, which is out of control. We sold it in late 2021 for like $1,025,000. And granted, we were on the receiving end of the market going nuts, so it was partly that we got a great deal. Another part of it was, we just created a lot of value through operating it well.
That's amazing.
We did some other interesting stuff when we leased up units where we'd lease a unit at above market price, but offer concessions, which is like that's what all the, when you go and look at what the best multifamily operators do, like if you go look at a building in Boston, for example, they always want to keep that rent roll nice and high. So instead of reducing their rent, they keep the rent the same, and then they offer half a month off your first month or something like that. So we were doing 12-month leases with a month free, but we were pricing it at like $1,850 a month, and maybe the market rent was $1,700. But when you go looked at a trailing 6 from a financial standpoint, whether you were a lender or a buyer, NOI was just much higher because we were getting another, $200, $1,200 a month in rent. And we were able to sell it for much more.
Wow.
And it also appraised for more when we went and appraised it during the
That is
refi.
so smart.
That is so smart.
Gee,
that was a good one.
that's a great
Yeah,
one.
no, we did really well on that one, and that was a perfect example of, I didn't want to sell it because it was just producing a massive amount of cash flow. It was paying like a lot of my bills personally, and I was like, there's just so much equity in this. It's so short-sighted to leave this equity in this property, to not take it out, and if we were to like draw a line from selling that deal to what ended up happening with all that money, we bought like 30 plus units in a portfolio deal with the proceeds from that, spiderwebbed into a bunch of other deals that just wouldn't have happened if we didn't end up selling it.
You bought it for $500,000. You put 5% down, so it's $25,000. You didn't do too much in the way of value add. It appraised when you went to go pay off that seller finance note at $775,000. You probably got a loan 70 to 75% worth of that, right? And then a couple years later, you sold it for $1 million.
That one deal has paid for the mail I'll send to my entire life.
Absolutely.
Right.
And it'll pay for a VA to do cold emails to sellers forever. Just that one deal. And we've obviously done more than that, right? And it's like every once in a while you get a screamer. And when you recognize that you got a screaming deal, lever up, buy it, like absolutely go all in, make the most out of it. Because you don't really get too many of those, right? So it's rare.
I think a lot of people, including us, we are totally guilty of this. Like we get hung up on like what the asking price is. It's like, well, of course we're not going to like pay more than what you're asking, but like you paid an extra 15 grand to get the deal done. And like at the end of the day, you knew how good of a deal it was. So like you said, 15,000 was nothing to you at the time because you sort of had this foresight to see that, okay, this is a good deal. Let's just make it easy, even 500,000, get the deal done, call it a day.
Yeah.
And everyone's really worried about beating the seller down. I got to get the best price, which you do. But if 500 is a good price and he's asking 485, bumping it 15 is nothing.
I talk about this every day. This psychological component about I can't give more than what they ask, but like that asking price is so subjective. Like, what's it mean to anyone? Like, it's like just go. Like do your research. You knew that market better than anyone. You knew that property was worth $500,000, and you were actually able to use that as leverage because you got a lower interest rate for it. It's a
and it was
win-win.
And the terms were really aggressive. I was like 3-day due diligence period. I'll go tomorrow with my inspector and I'll get you an answer by the afternoon.
Done.
And then we're good.
Awesome.
It's just so easy to be aggressive on terms. So many people, they just 14-day due diligence and financing contingency, and they don't have the ability to think outside of, how can we structure this in a different way that makes my offer extraordinarily compelling, whether you're competing with other buyers or not, but really just to the seller. And it's like, how long does it actually take you to do due diligence on a property? Really? It's a couple of hours with the home inspector and look at the leases. It's not rocket science, So it's like moving that from 14 days to 5 days oftentimes is a make or break for the seller. And then it's like, here's a $2,500 deposit that you can keep. And I read it. You can keep this if the deal falls apart after our due diligence period expires, outside of title issues. And it's like, I don't know, even if 1 out of 10 deals I can't close and I lose my deposit, it's such a small amount of money in the grand scheme, considering that it's going to get a lot of my offers accepted by including that language and giving the seller all the confidence in the world that I want to buy it, that it's like a calculated, the odds make sense, right? So it's a different way of thinking about it.
So funny you say that. I've been writing for some of my clients that are like, have some experience and are willing to do that. I literally just wrote an offer on a commercial building, 9 units in Norwich, Connecticut. Multiple offers, over asking. We gave them $10,000 over asking, but I wrote the contract where it was a commercial deal. So we had the 10-day due diligence, so a little bit less than we'll quote unquote normal, which is 12 to 14. But it was a $50,000 deposit, and it was non-refundable after the due diligence because he knows he can close. He like, if after my due diligence I'm good, like I know I'm gonna buy it. So why? Actually, what we did, and the agent called me afterwards. She goes, honestly, the way you wrote this contract was the reason why you won the deal. And it was, of the $50,000 deposit, $25,000 will be non-refundable.
That's amazing.
And it was after due diligence is complete. It's like, what's the difference?
If you've already gone through your
we know
deal,
it's a good deal. We know it's going to appraise.
Go hard.
Yeah.
Yeah.
So, it's so funny.
And I'll add to that too. Like this is maybe not something that I would recommend unless, this is like maybe you've been in the game for a while and you're okay with something like this, but we'll just release the deposit to the seller. Like it's not just going to sit at title, and if it goes sideways, you don't get it. It's like, no, after due diligence, no, you can cash that check.
We love that.
We just are doing it on a deal now. We're selling an office building in Simsbury, and that's exactly how he wrote it. He goes, non-refundable deposit after my 14-day due dil, and you guys can, and our attorney's like, yep, here he goes, wired it right to our account. Like, thank you.
Which is just, no one's doing that. You really want to outcompete other buyers. No one's doing that.
I got to know, because we do off-market marketing quite a bit. We've done, cold calls, texting. We've even wholesaled you a couple deals. We have run the gamut on marketing schemes. But one thing you mentioned, and this is, and I sort of run the marketing at Skytree here. So it's really tricky to get a commercial building owner, let's just say 10, 20, 30, 50 unit building owner, to sell you their deal on a postcard, on a cold call. Like, these people are probably going to be more experienced. They're not going to be as touched by your postcard. Like, if you could give us a secret or two in that regard, that would be amazing.
Number one thing that we communicate in all of our marketing, we're able to close, and we're not going to waste your time. That is by far the most important message that you need to get across. Is we're not like new and we're rifling out mail, or we're not going to, ask you for every single expense line item that you could possibly send us in a detailed rent roll, and we don't need to see all of your leases only to give you a bad offer. Here are references for people that we've worked with, brokers we've worked with, investors that we've worked with. So for us, it's a lot, all of the language on our direct mail piece is centered around, we've done 300 plus units in New Hampshire. We own a property management company. We've closed this amount of deals this year. We've worked with this many lenders this year, and all of that to say we are able to close. And if you can't say that because you haven't done the deals yet, then you should probably find a partner and leverage their track record so that you can say that. That's really important, because the last thing multifamily owners want to do is even just speak with someone about selling their building that they don't know if they can close. It's just kind of a waste of time. And the absolute last thing they're going to do is sign a purchase and sale agreement with someone that they don't know can close. So that's a big one. The other thing is, we talk about how we're going to make it a seamless transaction, which is pretty similar to what people do in the single family world, but it's less about quick close, cash, leave your stuff behind type of messaging, and more about we're not going to retrade, we're not going to bug your tenants that much, and we're not going to include a financing contingency. And again, it all comes back to security of close, like non-refundable deposit, no financing contingency. The really big one for the mom and pop owners out there, which is really true in the 10 to 50 unit space, where you have folks that have owned a property for a long time and have self-managed, is they're just petrified of their tenants, telling them that they're going to sell. Because if they tell them they're going to sell and then it falls out, then they might have some challenges on their hand. They're going to have some people moving out. They're going to have some turnover. They also just want to be really respectful of the folks that are living there, and they don't want to have to walk you through a bunch of different times, whether it's for an inspection or with a contractor and then with like an appraiser. And the absolute last thing a lot of these folks want to do is do like an open marketed sales process with a broker, where the broker is walking through 30 buyers over the course of 4 days. And it's just really stressful oftentimes for an owner to deal with that. So we very specifically say, you don't need to do that. We are going to make this a process to where your tenants aren't going to find out the building is being sold until a few days before closing, to avoid any of these challenges. So we're very intentional about that, which is really targeted to the mom and pop folks. So we're able to close. We're going to make this seamless and not carefree and not an emotional process for you. We always touch on no broker commissions. A lot of sellers love that. I don't know what it is about the older generation of sellers. A lot of them just are allergic to paying a broker, and they really like the idea of saving that themselves. And that's really center our messaging. And the last component I'll mention is, we realize that we're typically not going to send somebody an email or a direct mail piece or cold call, and then we're going to get a deal done the next day. We know that that's just really not how this happens. The vast majority of deals that we do direct to seller have a very long sales cycle, 12 to 18 to 24 months. And it's one thing to drop people in the top of the funnel. It's another thing to work them down. And that's really the big key here. Is we focus most of our energy on working the folks that we've already spoken with. So we send very value add newsletters on a monthly basis to sellers that we've chatted with, where it's like, here's some data that you might find helpful. Here's some articles you might find helpful that are all hyper local about the local multifamily real estate market. obviously we just follow up in a non-value add way. Hey, I know we spoke 6 months ago, just checking in, wondering if your plans have changed with the property. But we also treat it very much as networking, as in, we own a management company. We're very active in the local market. If you ever need a vendor referral, or you ever need to get in touch with a lender, or you're wondering, who might be doing this or that or what have you, ever need a broker, like, hey, if you don't want to sell it to us, that's fine. That's totally fine. And it's like, we're down to be helpful in whatever way we can, because maybe there's an opportunity that we collaborate in the future. And I've bought properties from investors, from sellers who then become investors in our business at a later date. And it's all because we led with a lot of value throughout that process. So I think where we stand out amongst folks that do like single family marketing and then also multifamily marketing is we're really, really obsessed with like the pipeline management of everything. And we're really diligent about that versus just trying to kind of cold convert people in a shorter time frame.
That is absolutely incredible. And a lot of the things that you said, we're not doing. So
It's gold. Thank you.
We've been looking at reinventing our CRM and getting drip campaigns and really staying in touch with these people. So that's just amazing that you're doing.
I think it's about
it makes
like
a lot of sense.
like automation or
Yeah, for sure.
So thank you so much. That was great.
Yeah, no, but let's get into the wrap-up questions.
Yeah. My question is, if you could give one piece of advice for someone that's just starting out, what would you say, or what would you suggest?
Consume content and educate yourself in a way that's aligned with the stage of your business growth or your just investing journey.
Yeah, I like that.
Basically consume education that aligns with where you're at. Because I think a lot of folks, they haven't bought a duplex yet, and they might be listening to an episode with somebody that syndicates large apartment deals. That has no bearing on what you're currently doing. Like, if you have yet to buy a duplex and you're just trying to figure out how to get that first deal done, you should be consuming education on how to underwrite a duplex, how to analyze a market, how to find a really good deal, and how you're going to put it together from a financing standpoint. That's all that matters in that current state.
Right.
And then start to consume other types of education once you get a little bit farther, but get really focused and narrow with what you need to do. And all you're trying to do in the beginning is just reduce how ignorant you are to everything that's happening. You just, the goal of the first couple of deals is not to make money. It's just to not lose money. You just don't want to lose money before you get going. Like, the entire objective should be do a couple of deals and just break even and just be in the game. And and you're going to learn so much on those first two that that propel you into doing more. That's really what the focus should be early on, is just making sure you're educated. And I always like to say competence breeds confidence. So the more you're educating yourself and the more you're understanding your market and how to underwrite and all of that, more confident your decisions are going to be, and the less likely it's going to be that you actually, get into a bad deal or lose money.
And I think a lot of people will get hung up at that they have to, on that first deal, they have to make $500 a month cash flow, or $400 a month, and it's just not true. Like, just buy your first deal. Like, like you said, don't lose money. It's okay to break even, especially if you're going to live in that property, if you're going to house hack, right? I mean, very hard, especially in today's market, to actually make a crazy amount of cash flow while living in the property. I mean, I don't know anywhere right now, at least in New England, that you can live in a 1-bedroom unit, 2-bedroom unit for less than $1,000. That's not a complete shithole. So if you can reduce your living expense by buying that 2 or 3, 4 unit building, living in one unit, and you're coming out of pocket a couple $100 a month, like, that's a win.
That's a huge
win. A huge win. Now you've gained, you've gone through the first deal, you've worked with an attorney, you've worked with a lender, you're now finding vendors and handymans and electricians and plumbers, or maybe you're handy yourself and you're utilizing YouTube to figure out how to do all that, but you're doing it. You took action, right? People go years just analyzing because the right deal hasn't come across. Well, you just miss 3 years of equity and pay down and appreciate, Absolutely. So yeah, no, it's great advice. Thank you.
Couldn't agree more. So I guess my question is, you've done a lot. You've syndicated, you've bought singles, duplexes, all the way up to probably 30 or 40 unit buildings. But if there's anything that you could go back and do differently, would you start syndicating earlier? Would you buy bigger properties earlier? Anything that comes to mind that you would do differently?
Yeah, I mean, I think the easy answer to say is I would have gone bigger sooner, but it's impossible to do that. And I think everyone says that, right? They always look back and say, oh, I wish I went bigger sooner. But in the moment, you don't feel like you have the knowledge required to do that. So, well, I wish I would have, because I would have taken advantage of a good point in the real estate market. I think it might be a little disingenuous. I think the one thing that I really do wish I did earlier was leverage other individuals, like hire internally faster. we brought on an acquisitions guy a year ago, and we're just doing way more deals. Like, who would have thought? Who would have thought that hiring a guy that's going to spend 40 to 50 hours a week solely on finding deals means we do more deals, right? It's so obvious, but I think there's a really big mental block for real estate investors. And I think it's driven by the choppiness of the cash flow. It's not like a small business where you kind of have predictable revenue, or, you can make a hiring decision and there's a very direct association with the value they'll create as an employee. It's a little bit harder in a real estate investment business to do that, but which is why I didn't do it for a while. And I just wish I had done that earlier, because, there's two levels to your skills, right? It's like being able to actually do the things that you believe you're good at. And then another thing to teach, manage, and lead someone to do that stuff. And then you're leveraging other people's time and you're downloading your abilities onto somebody else, freeing yourself up to do more stuff at a higher level. We had our direct to seller process down a while ago. And, just scarcity mindset, maybe an ego thing. It's hard to imagine somebody else doing it. And in reality, a lot of people can do what you can do as a business owner, right? It doesn't just have to be you. So I wish I had done that earlier, because it would have allowed us to grow even faster than what we did, and embraced, hiring and maybe making less money in the short term, and taking less off the table in the short term, but building the foundation to grow a much bigger business in the long term, which is trying to, that's what I'm doing now, trying to catch up on that.
Yeah, that's really good.
Really incredible.
Thank
I'm
you.
so passionate about that. Like, I think we should discuss this after the show.
I know, right?
Maybe
I took a bunch of notes.
Yeah, maybe we need to make a hire. I mean, I think the basic premise when you're hiring people is like, they should at least be making you, I mean, we're just talking about the real estate business, but like, if you're paying someone $60,000, $65,000, $70,000 a year, like, are they making that for you in return? Like, are you doing a couple wholesale deals at $20,000 because of deals they found? Like, I would say that if they are, then they're more than worth it, because that's just year one. Now their feet are wet. Year two, they're going to be doing more and more and more. So something to consider.
It's a no-brainer. Awesome.
The hardest part of hiring is when you look at the graph, you go below the line for a decent amount of period, and then you shoot up above it, right? And it's just the emotional volatility of dealing with that below the line period of 6-9 months, and then bang, it all kind of clicks, and you're like, oh, why didn't I do this sooner? I think that's great. I think that's just a business ownership thing that everyone contends with at some point.
Absolutely. Well, I appreciate your time. Thank you so much. If people want to learn more about you, where can they find you? And we'll include all this in the show notes as well, but just curious.
For sure. Yeah. So podcast, the Multifamily Wealth Podcast, talking multifamily on there a couple of times a week. Instagram is at Multifamily Wealth. I'm active on there as well.
Awesome.
If you just want to shoot me an email, if you're doing deals in New England, we're always looking for multifamily deals throughout Rhode Island and then in Southern New Hampshire. Axel, AXEL at alignedrep.com. And then I'll do a little shameless plug. We have an off-market multifamily deals program that we sell, help people, learn how to find, basically build a robust pipeline of off-market multifamily deals. And we donate 5% of the gross sales to homeless shelters in New Hampshire.
Awesome.
So
really
we always, I always feel shameless in plugging that. So that's multifamilywealtheducation.com/off-market.
Yeah, we'll definitely include that in the show notes as well.
Yeah, that's incredible.
Well, thank you again. It's been an honor. And I'm sure we'll catch up afterwards. I have like 1,000 more questions for you, so we'll do that offline. But stay tuned and like and subscribe. Thank you.
See you next time.